Welcome to this month's Economic Update. I'm Sinead Rafferty, Portfolio Specialist at NAB Asset Management, and today I'm joined by our Senior Economist Bob Cunneen. Welcome, Bob.
Thanks, Sinead.
Bob, it was a strong market performance for global share markets in the month of March. Can you tell us what were the drivers behind that?
Yes, so the American share market recorded a 1.5% return, and the Chinese share market was up 2.4%. So a couple of key drivers there. Firstly, hopes that the trade dispute between America and China would be resolved. Now, they're currently still in negotiations, but the market's taking the view that there'll be an eventual settlement between America and China. And the second aspect was signs from the Federal Reserve, the American Central Bank, that they would be patient on interest rates, which the market has interpreted that interest rates are on hold in America and the central bank's not likely to raise interest rates over the next couple of years.
What about the Australian market? It was pretty flat over the month. How did the different markets or the different sectors perform?
So the Australian share market only returned about 0.7% for the month, and there was a couple of mixed performances there. We had a very strong performance from the Australian REITs, so listed property trusts. They were up 6%, and consumer staples were up about 4%. So there's your Coles and Woolies. So from that point of view, they were running on the low interest rates or hopes for a Reserve Bank interest rate cut this year. Against that, the energy sector was weak. They were down about 4%, and our banking sector was weak as well, down about 2.8%. So competing forces at play, but the Australian share market was pretty modest for March itself.
And the Australian 10-year government bond yield hit historic all-time lows in March. What was the reason for that?
Well, to put in perspective, the 10-year government yield was below 1.8%, and Australia's inflation rate is about 1.8%. So essentially investors have taken the view that they need no inflation compensation to buy government bond yields, which is quite extraordinary. Now, what they're taking a view on is that the Reserve Bank will be under pressure to cut interest rates. Their view is that falling house prices, weak car sales, the decline in housing construction will warrant the Reserve Bank cutting interest rates before the end of this year. So it's quite an ambitious view, but that's what the bond market is telling us at the moment.
What about the US bond market? We saw the US yield curve invert in March, which can be in some cases a signal for a recession. What's your view?
Yes, so it's an extraordinary situation where the 10-year government bond yield in the United States is now below the cash interest rate. And the view here is that this is typically a warning sign that a recession is coming. But what we have to bear in mind with the yield curve when it does this is that it usually takes between 18 and 24 months before a recession actually hits. So it's not a precise clock. It's something that investors need to be conscious of, that this is towards the end of the investment cycle and that risks are building. But we need to be careful that you don't tip out of shares just because one indicator, such as the bond market with the yield curve, indicates signs for caution.
So one to watch. What about economic data? We've seen a mixed bag out of global markets in recent weeks. Positive labour markets in most countries, and yet industrial production and sentiment measures, among others, are looking quite poor. What's the outlook for interest rates globally?
Well, the outlook is very benign. So most of the central banks have indicated that interest rates are on hold. So if we look at America and Europe, that's the situation. What's quite interesting is China is easing interest rates at the moment. So they're providing more stimulus to support their economy. And there's obviously pressure on the Reserve Bank here to do the same. So it's a very mild interest rate environment. So it's still supportive of global share markets. And that's what we're seeing in the year to March, essentially.
Thanks for your time, Bob.
Thank you, Sinead.
And thank you for joining us.